Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CONAGRA Brands Inc. quarterly report. CONAGRA Brands Inc. operates as a consumer packaged goods food company with a diverse range of businesses and services. The company's grocery and snacks segment offers shelf-stable food products through various retail channels, including brands such as Bird's Eye, Marie Callender's, and Duncan Hines. The refrigerated and frozen segment provides temperature-controlled food products to consumers through various retail channels. CONAGRA Brands also operates in the international market, offering a variety of food products in different temperature states through both retail and food service channels outside of the United States. In addition to its consumer-facing businesses, CONAGRA Brands has a significant presence in the food service industry. The company's food service segment offers branded and customized food products, including meals, entrees, sauces, and custom-manufactured culinary products packaged for restaurants and other food establishments. CONAGRA Brands' portfolio of brands includes Bird's Eye, Marie Callender's, Duncan Hines, Healthy Choice, Slim Jim, Ready Whip, Angie's, BOMCHICKAPOP, among others. With a rich history dating back to 1919, CONAGRA Brands has established itself as a leading player in the consumer packaged goods food industry. CONAGRA Brands, Inc. market capitalization of $8 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that CONAGRA Brands, Inc. holds a significant advantage in their industry. CONAGRA Brands, Inc. trades at a lower price-to-book ratio of 0.92 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 57% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The company have a dividend yield of 8.88%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline in a company's financial performance can be attributed to several key factors. On the one hand, revenue decline is often driven by macroeconomic uncertainty and weakened consumer sentiment, leading to increased discount rates and lower market multiples. Additionally, downward revisions to projected sales and profit margins for specific reporting units, such as refrigerated and frozen, can also contribute to revenue decline. On the other hand, revenue growth is typically driven by strong performance in key segments, such as grocery and snacks, international, and food service. These segments have shown significant net sales and operating profit growth, indicating a positive trend in revenue generation. However, it's worth noting that some segments, like refrigerated and frozen, have experienced mixed results, with declining net sales and operating profits. Other factors that can impact revenue growth or decline include input cost inflation, unfavorable operating leverage, and the sale of businesses. While these factors can be challenging to navigate, they also present opportunities for companies to adapt and innovate in response to changing market conditions. Ultimately, a company's ability to manage these drivers will play a critical role in determining its overall financial performance. The net income of the company experienced a decline between CONE 2025 and CONE 2026 by $54.7 million. This trend continued throughout the year, with a significant decrease of $1.195 billion when comparing YTD 2025 to YTD 2026. The third quarter of fiscal 2026 also saw a drop in net income compared to the same period in fiscal 2025. The profit margins of the company underwent changes as well. The gross profit margin decreased by 1.4% from CONE 2025 to CONE 2026, indicating a decline in profitability. However, the operating profit margin showed an increase of 1.7% during the same period, suggesting some improvement in operational efficiency. Despite this initial increase, the operating profit margin declined in the first 3 quarters of fiscal 2026 compared to the same period in fiscal 2025. The reasons behind these changes are multifaceted. Goodwill impairment charges and other intangible asset impairments contributed to the decline in net income and profit margins. Additionally, input cost inflation, unfavorable operating leverage, and a reduction in profit from divested businesses also played a role in this trend. The combination of these factors resulted in a decrease in both net income and profit margins over the specified period. The company's ability to adapt to changing market conditions and manage its costs effectively will be crucial in reversing this trend and improving its financial performance. The company's financial performance indicates a consistent trend of generating positive operating cash flow. According to the extracted summaries, this trend has been observed in both fiscal years 2026 and 2025. The confirmation from page 37 further solidifies this conclusion, providing clear evidence that the company is indeed producing positive operating cash flow. The analysis on page 30 also supports this finding, highlighting the impact of depreciation and amortization expense on the company's overall cash flow. This suggests that the company's ability to generate positive operating cash flow is not a one-time occurrence, but rather a sustained performance over multiple years. The company's debt level and interest expenses have undergone significant changes in recent periods. In terms of debt level, the total liabilities have decreased from $12,001.20 to $11,048.20, while the total debt has decreased from $19.6 billion to $17.4 billion. Additionally, the company repaid $1 billion aggregate principal amount of 4.6% senior unsecured notes on November 1, 2025. However, in fiscal 2026, the company used $1.28 billion in financing activities, an increase of $365.7 million from fiscal 2025. Regarding interest expenses, there has been a notable decrease across various periods. For instance, in the 13 weeks ended February 22, 2026, interest expenses decreased by $0.3 million, and interest expense has decreased by $0.9 million compared to the same period last year. Furthermore, in the third quarter of fiscal 2026, interest expenses decreased by $7.8 million. Overall, while there are some fluctuations in debt level, the company's interest expenses have shown a consistent decrease across different periods. The performance of various segments within the company has been inconsistent across different periods. The grocery and snacks segment was the only one to show a positive operating profit, with $216.7 million. However, this segment still performed poorly due to significant decreases in operating profit by 10.6% and 15.5% in the third quarter and first 3 quarters, respectively. The refrigerated and frozen, international, and food service segments all showed negative performance. The refrigerated and frozen segment had an operating profit of $104.8 million, but experienced a decline of 15.4% and 27.9% in the third quarter and first 3 quarters, respectively. Similarly, the international segment's operating profit decreased by 5.4% and 6.5% in the same periods. The food service segment also performed poorly with a decrease in operating profit by 9.2% and 14.6% in the third quarter and first 3 quarters, respectively. Overall, it is clear that all segments except grocery and snacks experienced significant declines in operating profits across different time frames. Management is signaling a cautious approach to the company's outlook and strategy in light of ongoing economic volatility. The adoption of new accounting standards and recognition of impairment charges reflect a focus on transparency and financial discipline. However, management also emphasizes its commitment to long-term growth and improvement through strategic resource allocation. In response to inflation and changing trade policies, management plans to continue evaluating the macroeconomic environment and taking proactive steps to mitigate negative impacts on the business. This includes focusing on productivity initiatives and targeted pricing actions to offset input cost inflation. Additionally, management prioritizes maintaining sufficient liquidity to retire or refinance long-term debt at maturity while preserving investment-grade credit ratings. Overall, management's strategy appears to balance short-term financial prudence with a commitment to long-term growth and improvement. By acknowledging the challenges posed by economic volatility and taking proactive steps to address them, management aims to position the company for sustained success in an uncertain environment. The company has made several strategic acquisitions and divestitures in recent years. In terms of acquisitions, the company has purchased Pinnacle Foods, Inc., Sweetwood Smoke & Co., and a contract manufacturer. These acquisitions are expected to enhance the company's product offerings and expand its market reach. On the other hand, the company has also engaged in several divestitures. The Bird's Eye brand name was sold, as well as the spreads businesses, including Earth Balance and Smart Balance. Additionally, the Chef Boyardee business and frozen fish business are set to be divested in the first quarter of fiscal 2026. Other notable divestitures include the Mrs. Paul's and Van de Kamp's businesses, as well as the company's ownership stake in Agro Tech Foods Limited, ATFL, which is also expected to be sold by the first quarter of fiscal 2025. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts to its investors, with $502.2 million being distributed in both 2026 and 2025. In addition to paying dividends, the company has also been actively buying back shares from the market. The total amount spent on share buybacks was substantial, with $15.3 million allocated for this purpose in 2026 and a larger sum of $64 million in 2025. Furthermore, the company repurchased 0.8 million shares for $15 million in the first quarter of fiscal 2026. Overall, these actions demonstrate the company's commitment to returning value to its shareholders through both dividend payments and share buybacks. There are concerns about inventory buildup and supply chain disruption. The data suggests a significant increase in inventories, with finished goods inventory rising by $130.1 million. This is a notable increase from the previous year, where inventories increased by $71 million. Furthermore, there are also temporary manufacturing disruptions reported in the refrigerated and frozen segment, which could indicate potential supply chain issues. These disruptions may have an impact on the company's ability to meet demand and maintain a stable supply chain. Overall, these concerns highlight the need for careful management of inventory levels and supply chain operations to mitigate any potential risks. That concludes the financial summary for CONAGRA Brands Inc. Feel free to comment below, and I will be happy to answer them when possible.